Ever wonder what it truly takes to, understand a company's financial heartbeat? Today, we're pulling back the curtain on a fascinating new set of sources.
Yeah, it's always interesting to get into the real numbers.
Exactly. So this deep dive is all about Control Print Limited's Q1 FY26 financial results. That covers the quarter that wrapped up on June 30th, 2025.
And we've got quite a bit to work with here.
We certainly do. We've pored over the official unaudited financial results, both the standalone and the consolidated versions,
Mm-hmm.
plus their detailed investor presentation for Q1 FY26.
And crucially, that limited review report from the auditors. Can't forget that.
Absolutely. So our mission, really, is to pull out the most important bits of knowledge and insight for you, give you
Okay.
a shortcut to being well-informed about Control Print's recent performance.
And maybe highlight some surprising things that you might miss just skimming the reports.
Precisely. Those little details often tell a bigger story. Okay, let's unpack this. Right, kicking things off with the headline numbers for Q1 FY26. So that's April 1st to June 30th, 2025. The board of directors gave these results the green light on July 21st, 2025. Now, for the standalone revenue from operations, it hit Rs 1,004.49 lakhs for Q1 FY26.
Right, and for listeners maybe not familiar, a lakh is 100,000 Indian rupees. So we're talking just over 100 million rupees.
About $12 million USD, roughly.
Yeah.
And get this, the company calls this their highest ever Q1 revenue.
That's quite a statement. Highest ever Q1 revenue.
What?
It's not just a number, is it? It really signals strong momentum in their core Indian market.
Definitely suggests good traction.
Yeah, potentially market share gains or just really robust demand. And this standalone figure, it actually grew by 13.87% compared to the same quarter last year, Q1 FY25.
So a solid year-on-year increase for their main domestic operations. That's like the engine room, right?
Exactly. It powers everything else.
It's a really strong start to their financial year, at least domestically. Now, when we pivot to the consolidated revenue from operations, this includes all their subsidiaries, Indian and international.
Right, the bigger picture.
The numbers there are also quite strong. Ours 1,112.85 lakhs for Q1 FY26.
Okay.
This also shows healthy growth, 13.75% year-on-year compared to Q1 FY25.
So pretty consistent growth on the top line, both standalone and consolidated, about 13-14%.
Yeah, good top-line growth across the board. But now we hit the first, let's say, puzzle piece.
Oh, okay. Let's hear it.
Let's talk profitability,
Yeah.
specifically the standalone profit before taxation, or
Okay.
PBT. So that's basically their operational profit before tax and any, unusual items.
Got it. Core profitability.
For Q1 FY26, that was RS 265.64 lakhs. And this shows really strong growth, 30.4% year-on-year compared to Q1 FY25.
Wow. Okay. Over 30% growth in standalone profit. That's significant.
It really is a big jump for their core domestic operation.
Right. And this, I think, is where it gets really interesting because you see this divergence.
Exactly.
The standalone numbers look great, robust profit growth, but the consolidated profit before taxation, again, we're excluding those exceptional items for a moment for Q1 FY26, was Rs 138.64 lakhs,
Which is?
which is actually a decrease of 12.36% compared to Q1 FY25.
Okay, hold on. So standalone profit up over 30%, consolidated profit down over 12%.
Precisely. That's the divergence. That's the central kind of mystery in these results.
So the core Indian business is flying profit-wise, but when you add in everything else international, subsidiaries, the overall profit actually dropped.
Yeah.
What's your first take on that? Red flag? Or just complexity?
It's definitely a flag worth noting. It immediately tells you that while the core domestic business is thriving, something else, something significant, is dragging down the overall consolidated performance.
Something outside India, probably.
Likely in their newer ventures or the international operations, yes. We absolutely need to dig into what's happening outside that standalone entity to understand this properly.
Okay, and just to round out that contrast, the reported standalone PIT profit after tax came in at Rs 212.64 lakhs. That's up 31.25% year-on-year.
Following that strong PBT growth.
Right, and the standalone EPS, earnings per share, also climbed nicely, of course, 13.30, up 31.29% year-on-year. So bottom line, the standalone entity really delivered.
Yes, but then you look at the consolidated side again. The reported consolidated PET was Rs 85.65 lakhs.
And compared to last year.
That's actually down 26.52% year-on-year.
Wow.
And the consolidated EPS followed right along, dropping to Rs 5.35, which is down 26.61%.
So the gap is even wider after tax.
It is. It's fascinating, isn't it? Strong standalone profit performance, but clear headwinds hitting the consolidated results. That difference is a huge takeaway here. Understanding it means unpacking a few very specific details.
Okay, let's zero in on one of those details then. There's this line item called exceptional items.
Yes. Always look for the exceptional items.
For Q1 FY26, both the standalone and consolidated results show a credit. So income of ours, 399.04 lakhs. That's a pretty big number, right? Almost 40 million rupees.
It's absolutely huge in the context of their profits, and it's critical to understanding the quarter. This amount, it represents a grant.
A government grant.
Yes, received under the Central Capital Investment Incentive for Access to Credit, or CCIAC. It came from the Directorate of Industries, Government of Himachal Pradesh.
Okay, what was it for?
Think of it as a capital investment subsidy. Specifically, it was 30% of the investment they made in plant and machinery way back in FY 2020-21. For their mask division, actually.
Oh, right, during the pandemic push.
Exactly. Now here's the crucial part. The useful life of that machinery was determined to be 3 years. That time has now passed. Depreciation's already been applied over those years. So the entire grant amount, that Rs 399.04 lakhs, was recognized as exceptional income in this single quarter, Q1 FY26.
So it's a big one-time boost, not operational profit?
Precisely. A significant one-time boost to their income. It helped those standalone numbers look even better, but it won't happen again next quarter. It's important for you, the listener, to mentally adjust for that.
Got it. So that exceptional income explains a lot of the standalone profit jump. Okay, shifting gears slightly, let's talk margins. Standalone gross margin for Q1 FY26 was 56.47%, which is actually a bit down from Q1 last year, where it was 61.65%. What's going on there?
Well, the company gives a pretty direct explanation in their presentation. They say, and I'm quoting loosely here, softer GM led by higher printer sales.
Higher printer sales lowered the margin. That sounds counterintuitive.
It does at first glance, but think about the classic razor and blade model.
Right, sell the razor cheap, make money on the blades.
Exactly.
Yeah.
Control Print sells coating and marking printers, and then the consumables, inks, solvents, etc. This implies a strategic choice. They're pushing more printers out the door, possibly at a lower immediate margin.
To build that installed base.
Precisely. Build a larger base for future, likely higher margin, consumable sales. It's a long-term play, sacrificing a bit of immediate gross margin for future recurring revenue.
Makes sense strategically. And despite that slight dip in gross margin, their standalone EBITDA margin, that still held up pretty well, right? It was 22.06% for Q1 FY26.
It did. And just to remind everyone, EBITDA earnings before interest, taxes, depreciation, and amortization. It's a key measure of core operating performance.
Strips out financing and accounting decisions.
Right. So that 22.06% tells us that even with those strategic choices maybe squeezing the gross margin a bit, their core operations remain quite profitable after accounting for their operating expenses like sales, R&D, admin costs.
Good context.
And just to connect this back to their strategy, that installed base of printers, it's now over 21,500 units.
That sounds like a lot.
It is significant because every one of those printers potentially needs consumables down the line. So a larger installed base directly fuels future growth in those recurring sales. Their sales and promotion efforts are clearly paying off in getting those printers placed.
Okay, so where's this revenue growth actually coming from? The investor presentation gives some detail on sectors, right?
It does, yeah. It gives a really useful granular view. It mentions sectors like pipes, food, dairy, cable and wire, steel and metal and wood, saying Control Print continued to see market share consolidation in these areas.
So gaining share from competitors in established markets.
Seems like it. And what really stands out is they specifically call out good traction for their products in dairy, sugar, plywood, and cement industries.
Interesting. Any idea why those specifically?
The report doesn't spell it out, but it could be due to specific product launches, targeted sales efforts, or maybe regulatory changes in those sectors favoring their solutions. But it tells us precisely where they're seeing strong momentum right now. It gives a clearer picture than just a single overall growth number.
Right, it adds some color to the numbers. Okay, so that's the quarter itself. But beyond these numbers, what's really compelling is understanding where Control Print sees itself heading, long term.
Absolutely. The strategy piece.
Let's pull back and look at their strategic horizon. Yeah. Because they've laid out a pretty clear three-pronged long-term growth strategy.
They have. It's quite ambitious. The first pillar is, unsurprisingly, growing their core coding and marking business.
Their bread and butter.
Exactly. They want to outpace industry growth here in India, but also grow their European businesses, Mark Print and Codeology.
And they're bringing international tech to India, too.
Yes, bringing products developed internationally into the Indian market, and they've even set up a new subsidiary in the Middle East to go after opportunities there.
Expanding geographically.
Definitely. And strategically, this makes perfect sense because coding and marking is still, what, 95% of their consolidated revenue?
Yeah, the vast majority.
So its continued expansion is absolutely fundamental to their whole plan.
Okay, pillar 1.
Yeah.
Grow the core. What's pillar 2?
Pillar 2 is increasing their track and trace business. This is under the brand name Curious Codes.
Curious Codes, catchy.
Yeah. It offers cloud-based solutions focused on supply chain visibility and product authenticity. Think QR codes, traceability.
Anti-counterfeiting stuff.
Exactly. Preventing counterfeiting, meeting regulatory requirements like that government mandate for tracking the top 1,000 drugs. They're positioning it as a full-stack, end-to-end traceability platform.
So moving into a more high-tech, data-driven space.
Precisely. Higher value add, potentially higher margin down the road. It's a significant move beyond just printing codes onto products.
Interesting. And the third prong.
The third prong is entering and expanding in the packaging business under the brand V-Shapes.
V-Shapes? What's that about?
It focuses on innovative single-use packaging technology, like those little single-dose sachets you sometimes see.
Oh, okay. Like for gels or liquids.
Exactly. And it's not just the presentation notes a significant detail. They actually sold 2 packaging machines during Q1 FY26.
Ah, so it's generating revenue already. Real business.
It gives concrete visibility, yeah. They offer the equipment, co-packaging solutions, even the raw materials. So it's a clear diversification play into a related but distinct market.
So core growth, track and trace tech, and innovative packaging. That's the roadmap.
That seems to be the plan.
Now, beyond strategy, it's probably worth touching on some of Control Print's foundational strengths, things that underpin all this. For instance, they make a point of saying they are the only coding and marking company that actually manufactures in India, make in India.
That's a really strong point, especially now. A distinct competitive advantage, potentially in terms of cost, supply chain resilience, maybe even government preference.
Could be. And their reach across India seems pretty impressive too, serving over 2,700 PIN codes, a presence in over 1,700 cities and towns.
That's a formidable distribution and service network. It means they can get their products and support to customers pretty much anywhere in India. That's hard for competitors, especially international ones, to replicate quickly.
And financially stable, too. They mentioned their credit ratings.
Yeah, CRISIL A stable for long-term, CRISIL A1 for short-term. Those are solid investment-grade ratings, suggest financial health and ability to access credit.
Good foundation.
Right. And just quickly on their operational backbone, they have those 2 main domestic manufacturing facilities, Nalagarh and Himachal Pradesh.
Right. 30,000 QF feet.
Mm-hmm.
Making the core printers CIJ, LCP, TTO, etc.
And then the bigger Guwahati facility in Assam, 70,000 SQRF feet, that one does inks and solvents, plus TIJ and high-res printers. And it benefits from significant tax incentives being there.
So a well-invested manufacturing base.
Shows a strong, strategically located operational footprint. They're not just importing and selling.
Okay, now let's loop back to that initial puzzle we talked about, that gap between the strong standalone performance and the weaker consolidated profit.
Mm-hmm, the divergence.
The limited review report from the auditors, Kaur Mantri and Associates, they issued an unmodified review report on the Q1 results.
Ah.
That's generally good news, right? Means no major issues found.
Generally, yes. An unmodified opinion or review report is what you want to see. It means, based on their review, the financials present a true and fair view within the scope of a review, which is less exhaustive than a full audit. But
there's always a but in the details.
Yeah, often. There is a nuance here. This raises an important question, I think, for both of us and definitely for you, the listener, to consider.
Okay.
You need to look at the other matters section of their report.
The fine print.
Sort of. The auditors explicitly state that they did not review the interim financial results for several entities.
Which ones?
The Sri Lanka branch, several wholly owned foreign subsidiaries, some step-down foreign subsidiaries, and one Indian subsidiary called Innovative Codes Private Limited.
Okay, so quite a few entities weren't reviewed by the main auditor.
Correct. Their conclusion on the overall consolidated statement relies, in part, on reports from other auditors for some of these entities or on management certifications for others.
Right. So the main auditor is essentially saying, for these parts of the company, we're relying on what others told us, or what management certified.
Exactly. Now, what does this layered approach mean for overall transparency, especially when we saw that divergence in profitability between the clear standalone picture and the murkier consolidated one?
Yeah, does it explain the drop in consolidated profit?
It doesn't necessarily mean there's a problem with those subsidiaries, let's be clear on that. But it does mean that the consolidated picture, particularly for those international or newer ventures where perhaps the drag on profit is occurring, well, that picture isn't being directly scrutinized by their primary auditor who reviewed the core Indian business.
So for us trying to understand the why behind that consolidated dip,
It means you're relying on a bit of a patchwork of information for the full consolidated view. The core domestic numbers, signed off by the main reviewer, are clear. The rest, it adds a layer of complexity.
so maybe less transparency into the parts of the business that might be struggling.
Potentially, or at least the assurance comes from different sources. It's just something important to keep in mind when you're evaluating the company's overall financial health, and particularly its global performance, and the reasons for that profit decline we saw. It requires a bit more caution interpreting those consolidated figures.
Right. That makes sense. Okay, so let's try and wrap this up. What does this all mean for you, listening in? Control Print Limited, well, they showed strong standalone revenue and profit growth in Q1 FY26. That highest ever Q1 revenue is notable.
Definitely. But remember that profit was significantly boosted by that large one-time exceptional income from the grant. That's key context.
Absolutely key. And strategically, they seem to be playing the long game, making choices like accepting slightly lower gross margins now.
By pushing printer sales, aiming to build that installed base and fuel future, hopefully higher margin consumable revenue.
And they're actively diversifying, pushing into those new business lines, track and trace with curious codes, and packaging with V-shapes, plus expanding internationally.
Yeah, the strategy seems clear. Leverage the strong core business to fund expansion into new tech areas and geographies.
But, and it's an important but, this strategic shift, the increasing complexity of their global operations, that whole subsidiary structure.
And the auditing approach for those consolidated entities.
Right. It could mean that really understanding the full financial picture requires a deeper look. You need to consider the interplay between that robust, standalone domestic performance, which seems quite clear.
And the consolidating international ventures, where the results were weaker this quarter and the transparency might be, let's say, layered differently.
So the final provocative thought for you to mull over. What implications does this strategic diversification, moving into track and trace, packaging, new countries hold for Control Print's long-term profitability and its overall risk profile as it navigates these new complex terrains?
Especially given the potential growing pains we might be seeing hints of in these Q1 consolidated numbers. Something to definitely keep an eye on as you continue your own deep dives.